Hello, hello. Let me test the sound. Okay. Hello. Good evening. Hope you guys are well. Let's get started. We got tons of content today again. All right. So let's keep going. Without further ado. Okay, let's go. All right. Today we're going to talk about the Federal Reserve, the U.S. Central Bank. Um, if you're not here based in the United States, maybe you are not very familiar how it works. Different countries have different, their own monetary policy makers, and also, they take care of the fiscal policy, the monetary policy of of each country. They will deviate a little bit the way they work. So today we're going to talk about the Fed. All right, the Fed is really powerful, especially because of the power of the dollar. The U.S. dollar is a hegemonic currency in the world. Everybody uses it. So what happens here affects everyone else anywhere in the world. Okay, so that's why this is so important. But for us, investors in the United States, we have to be very um, cognizant of what's going on and how to read the Fed, especially between the lines, what they're, whatever they talk about or the decisions they make, what kind of impact we can, as investors, expect, and so we can take actions accordingly. Okay, so this is really really important because it's just like you're sitting in a in a table playing cards or any other game with a one player that is oversized so that whatever that this player does will affect everyone else. All right, so um, we're going to talk about this today. All right, again, just to get started, for those who are not in our club, we extend the invitation to join our club. All right, and the mission of the club is to empower investors to accelerate wealth growth through education by maximizing the return to risk ratio and outperforming the S&P 500 every year. Okay, what we want is to achieve higher returns, but at the same time, we want to be very, very risk management oriented. All right. So the risk 500, which is the risk indicator that we run here, uh, the number one task of it is to protect portfolios against crashes. All right. So that's number one. You can make money just by more. You can beat the S&P 500 just by avoiding the downside, the dangerous downsides. Of course, the market's gonna fluctuate, but you want to avoid those that are really dangerous. That's how you can beat the S&P 500 that way. But we have another layer on top of it to make money when the risk is low. We're going to talk about it today too. All right, so let's get started right now. Okay, so just a quick a recap what's been happening so far. um, this is until yesterday. We all strategies this year is beating the S&P 500. This strategy one is just S&P 500 or cash, so we rotate to cash to avoid the dangerous downsides. So you can see it can be the S&P 500 just by doing that. All right, the other strategies here, we add that extra layer to make money, to accelerate wealth formation when the risk is low. All right, we're going to talk about that at the end of the presentation. So if you stick to the end, you're going to hear about it. Okay, so and this is since January 1st, 2022 to today, cumulative returns. We are beating the S&P 500 by a lot. All right, even this one, strategy one, is beating by a lot already. Okay, let alone the other strategies. Okay, and this is just to show you that it's not just this year. We do it year after year after year. Right? 2022, 2023. 2022 was a bear market. The S&P 500 ended with 20% down. The 2023 was a bull market. Was pretty good, right? So we also did fairly well. Okay, okay, and then to 2024 we did well as well. Okay, 2025. All right, here we are. Right. Okay, just a quick chart here, but this is not I haven't updated yet. This is August. We're even higher now because the S&P 500 grew, and we all grew with it. All the strategies, the gap is enlarging and widening over time. Okay, so who I am? I'm a analytics driven investor, an entrepreneur, and I run a business, Risk Scientific LLC. We are a risk management solutions company. Okay. All right. I used to be a trader. I structured insurance and financial markets. All right, for 30 years combined. Okay. All right. So why the Fed matters, right? From the investor's perspective. Okay, the Fed is the most powerful market maker, just like the analogy that I was explaining earlier. It's just like you're sitting at a table playing cards or some other game, and you have one player that's oversized, super big, and he can move the entire dynamics of that game. All right, so this is the Fed. All right, his isn't just a regulator, is the primary driver of liquidity in global markets. All right. Sometimes, if you're not in the US, you're another country, your central bank, the reach of your central banks is probably, it's in your country, within the boundaries of your country. But the Federal Reserve, because of the power of the dollar, it affects the entire world. Okay, so its decisions on interest rates, money supply, and credit conditions set the tone for stock prices, bond prices, the dollar, which is the price of the currency, and real estate in the United States as well. Okay, so lower rates, interest rates means cheaper capital. You have higher valuations for companies, for stocks, for everything. Okay, all assets. Um, Bonds is exactly the same. The yields are directly tied to Fed policy. All right, it's gonna affect dollar strength as well because if when interest rates in the United States go up, typically the dollar goes stronger because it gets attracted. In the entire world, dollar reserves, they will move to the United States. Okay, so that's why the exchange rate will go up in favor of the U.S. dollar. In real estate, it's the same because that's exactly the price of the money in the U.S. All right. Okay. This illustration is from 2021, right? This is incredible because, like, feeding the bull market, right? Feeding the bull market. All right. Why changes in interest rates are so important, right? First, it reprices all assets in an economy. It's the cost of money or the time value of money. Because of those just two things, cost of money, time value of money, remember I said time, right? Time is so important. Okay. Interest rates are really important because of that, because it will reprice all assets in the economy. For example, for those of you who work with valuations, asset valuation could be stock valuation or property valuation, right? Usually, what do? You get in your calculations, you're gonna get the cash flow that you receive from your asset. But how do you do its valuation of the asset? The You will take the power of the cash flow and present value to today, right? You are always present valuing your future cash flow, projected or otherwise, right? You're always um, present value by what? By the interest rates. Okay, so that's why it's so important, because if the interest rates go up, what's going to happen? Your denominator of your formula is going to go up. So that means the price, the valuation is going to go down, and vice versa, right? Okay, so that makes the equation work. All right, so that's why changes in interest rates are so important, and because the Fed has the power to move interest rates, it's tied to their policy. Then that's why we need to know, what the Fed's doing and what kind of impact it can have in the market, and especially on your investments. All right, perfect. Okay, the Fed has a dual mandate. Okay, central banks around the world may differ on this, but in the United States, the Fed has a dual mandate. Number one is price stability. They have to fight inflation. They got to control inflation and keep it low. That's number one mandate. The second mandate is maximum employment. All right. So they have to make sure unemployment is low. We want to avoid recessions. That's the second goal of the Federal Reserve. You may say, well, those two goals may conflict with each other, right? It may. It can conflict. All right. We're going to talk about that, because tightening to fight inflation can cause job losses, while easing to boost jobs can fuel inflation. Okay. As an investor, this tension creates predictable cycles, which is good. We call it hawkish phase, when rate hikes um, are orchestrated by the Fed to slow inflation. So risk assets, their prices tend to fall. We call it Fed tightening. All right, that's the terminology that we use. You need to get used to this terminology. Okay, so dovish means easing, hawkish means tightening. All right, so dovish phase, what happens is that the Fed's gonna cut rates to stimulate growth, and risk assets like stock prices gonna rally. All right, because of that, the most watched and most important indicators of all the economic indicators, what are them? Number one, payrolls. All right, employment. Number two, core CPI or core PCE. Those measure inflation in the United States. All right, so there are so many other indicators like industrial production or GDP or whatever. There's so many. But the most important ones and most watched are payrolls and inflation. All right, especially consumer inflation, and more specifically, core inflation, which excludes food and energy, which are considered very volatile. All right, if the core is going up, it's not a good thing. All right, okay, so they're market movers. If there's a surprise different from what the market's forecasting, then the market can move big time. I've been to so many times, I've seen this happen. All right. Because, for example, the non farm payrolls um, in the last decade were more important than the core CPI, than inflation, because inflation was very low. Right. So payrolls became like the king of the market. Every time there was because every month, right? Every month we have a new payrolls that are being uh, published. But at that time, everyone's watching. The entire market just stops. The market pretty much, goes into a very wait and see mode, just to see what's going to happen with the payrolls, and it's going to react strongly if the market gets surprised. Okay. All right. So what's the investor's problem? The Fed is often behind the curve. All right. So just like us, the Fed is also reactive. It's not proactive. It waits for data. All right, he's gonna make moves based on the data that they're seeing. Okay, so this lag creates opportunity for investors who can anticipate moves, but it's risky. Okay, it's all right. It's risky. It's not a sure thing. For example, in 2020 pandemic, the Fed cuts rate to near zero, launched a QE. We're going to talk about QEs, quantitative easing. All right. So here, because of the pandemic, the government got very scared about what's going to happen with the economy, so they need to stimulate the economy, right? So the Fed immediately cut rates to almost zero, right, and launched QE. QE is to expand the monetary base of the country. So you can also think in terms of printing money, pretty much, right? Print more money, right? So give money to the people. That's what it means, really. Okay. So and that fueled the fastest bull market recovery in history. Okay. All right. So that happened. Everybody received the checks. You know, stimulus here, stimulus there. Help. Government try to help individuals, try to help companies, okay, during the pandemic, and a lot of that money found its way to the stock market, right? A lot of people, they were like locked down and at home, and they spent the money buying stocks, right? So that fueled a huge bull market. All right, 2022 was a tightening cycle, right? Because the Fed, the inflation just spiked, and the Fed was again behind the curve, which is normal, right? And it started to hike aggressively. So both bonds and stocks went down that year. All right, both bonds and stocks. All right. So here's just a little illustration here how this thing works, right? So if the inflation is too high, it means that your economy is too hot, it's running hot, right? So the Fed is going to tighten, going to increase rates and increase money in circulation. So that's gonna happen, right? That sorry, it's not gonna increase. So just a correction here. Tightening means increasing interest rates, but also reducing the amount of cash in circulation. All right, so that's tightening. If you do that, you will it's pretty much throwing cold water to a hot economy, right? So you risk doing overdoing it and causing unemployment to increase until the point that unemployment is too high. All right, or you are entering a recession. Oops, that you overdid. So it's time to change the stance and start easing. When you ease it, it will go back. It can, if you overdo it, inflation is going to increase and economy is going to run too hot. So it's a cycle, right? But the worst Fed dilemma is stagflation. Stagflation means inflation is high and unemployment is high too. So what do you do, right? So you're going to be in a situation where how do you make a decision here? And actually, this may be a scenario, a likely scenario that we are heading to now in 2025 to 2026. It's possible because tariffs, it's a risk that's around us here for inflation to increase, and we are already seeing the labor market weakening. So we may come to a situation like this. In a situation like this, what do you do, right? So this illustration here, it's funny, but that's what makes the job of the Fed hard, right? It's very hard. What do you do, right? If you increase, you do a rate hike, you know, because you want to combat inflation, but at the same time you can cause recession, right? So what should you do, right? It's not an easy answer, especially in a situation where you are heading to stagflation. That's why um, the Fed has been very hesitant in cutting rates, even under immense pressure from uh, from Donald Trump, right? So he's being very, very cautious. All right. Okay. A reason why you cannot afford to just ignore the Fed, right? The Fed is effectively the fourth branch of government for markets, right? Ignoring Fed signals is like driving without paying attention to traffic lights. All right. Here's what, in this is ChatGPT, right? Sometimes I use AI to help me prepare my classes here. So, so here I think it I, the way it explains here, it makes sense. It's correct. It's not wrong, but it can guide long-term positioning, but it's far from ideal. All right. Actually, it's one input to the RISP 500 algorithm. We use it, right? It's very, very important. All right. Okay. So a quick overview. What is the Fed, right? What is the Fed? It's the Central Bank of the United States, established in 1913 by the Federal Reserve Act. Mission is to promote a stable, secure, and efficient monetary and financial system. What's the structure? You have a board of governors, you have 7 members appointed by the US president and confirmed by the Senate, right? There are 12 regional Federal Reserve banks located across major districts, all right? The Federal Open Market Committees, the FOMC, is the policy-making body, and it includes who are making those decisions, right? So 7 board governors, those guys here, right? The president of the Fed, right? The New York Fed, right? And 4 of the remaining 11 regional bank presidents, right? These people rotate, right? And the main objective, again, this is the dual mandate, is price stability and maximum employment. That's their mandate. All right. There's an unofficial third mandate, which is to maintain financial market stability. We're going to talk a little bit later today. Okay. All right. So how these people come to this, to their roles? Um, well, it's made to be independent. All right. So governors serve staggered uh, 14-year terms to limit political pressure, right? Because they're not, their terms don't coincide with the president's term. Okay. Even though this is being, Donald Trump wants to change this, right? He's already putting a lot of pressure on Jerome Powell. Uh, but we'll have to see what would be the consequences of this. It's not good. All right. Fed chair and vice chair chosen by the president from existing governors. The 4-year renewable terms. Funding is independent. They have their own operations. Policy decisions are meant to be insulated from direct political influence. All right. Who were the Fed chair so far? Since Paul Volcker, we had Alan Greenspan, we had Ben Bernanke, we got Janet Yellen, and then now Jerome Powell. Okay. They oversaw uh, very different periods. They came to their chairmanship when the economy was in very different stages. All right, and they um, like them, hate them. They did what they could. Okay. All right. So what about the FOMC, right? The committee. They meet eight regularly scheduled 8 times. Okay, per year. So it's like roughly six week every 6 weeks. So January, March, May, June, July, September, November, December. Right. What they produce a statement where they will lay out their policy decision and guidance. All right. The summary, of course, they're going to talk about the economic projections that they're making, including the dot plot. I'm going to show you what the dot plot is in a minute. Press conference. All right. So Jerome Powell, he will be interviewed. He will have a press conference after the meeting. And the minutes of the meeting is going to be released 3 weeks later. Okay. And the market watched the minutes too. Okay. It's not something that, oh, yeah, well, the decision has been made. The chair spoke with the press, and that's it. Actually, no. When the minutes is released, the market's looking at the minutes too because they want to see the words. Okay, so one of the things we're going to talk soon today, it's about Fed speak, right? So uh, about their communication, because you can get clues about their policy making stances and what they're thinking from the minutes, from everything. Every word that they say is scrutinized by the market. Okay, so that's how it works. All right, you got to be very careful what you say. All right, so what guides this policy making? Key economic indicators, inflation, of course, labor data, GDP growth, etc. Right, financial conditions, credit spreads, they watch all this, right? They equity market behavior. They're looking at stock market. Okay, they're not immune to the stock market. We're going to talk about this as well. There's something that's believed to exist called the Fed put. All right, we're going to talk about this in a minute. And bond yields, uh, of course, they're looking also at global economic risk and systemic stability considerations. Okay, they have to look at all this to make their determinations and decisions. All right. Okay, so just in a glance, what happens? Here's the structure. Okay, who sits in the committee, right, making this decision? Their objectives: price stability and maximum employment. The FOMC meets 8 times per year, and they will produce the statement, economic projections, and the press conference. All right. These also move markets. All right. So if here's the thing. Usually, the Federal Reserve doesn't want to surprise the market. It's bad to surprise the market, right? If you come up with a decision that's not widely expected by the market, you can move the market one way or the other, right? So you want to avoid this. So what the Federal Reserve does is between meetings, you see there are so many there's several governors and so they will speak with the press from time to time, and they will give clues about what the decision might be. Okay, so they want to telegraph in advance to the market so that the day they meet and release their decision, it's not going to come as a great surprise to the market. All right, to just to minimize the volatility that may happen if if the market gets disappointed or too enthusiastic, or basically they had never foreseen this coming. It's bad. All right, so they try to avoid this. Right, perfect. Okay, so let's understand the nitty gritty, how this happened, right? How can the Fed influence or determine where to set interest rates, right? There is a market called the Fed funds market. Okay, what's the Fed funds, right? What Fed funds mean? Um, there's a Fed funds interest rate, which is the rate at which banks lend overnight balance to each other to meet reserve requirements. So the Fed has set reserve requirements for all the banks, and the banks will have their activities during the day. They will borrow money, they will lend money, right? So if their balances are not meeting the reserve requirements set by the Fed, they need to square their balances. So let's say bank A uh, lend too much, right? Lend too much, and they need to have at least X amount of dollars, overnight. Uh, they they just lend too much, and they need to borrow. And then there's Bank B, which received too much deposits that day. Didn't lend too much. It just got too much deposits. So he had extra cash. So what they do? Bank B will lend to Bank A. So both banks get balanced. All right. And at what price do they agree to do this? It's the Fed funds rate. Okay, so it's the interbank overnight rate between banks, basically between banks. All right. Um, that is a overnight rate, which means is cost of money for 1 day. All right. It's not a long term lending. No, it's just 1 day. All right. One night. Let's put it that way. It's a one night. All right. And it's market based. There is an actual market, right? Usually this market is super active. It's active during the day, but it's super active at near the close, right? When the banks are closing, they got to do that. So if a bank received too much deposit that day, they had extra in their in their in their on their balance sheet, they will get penalized if they do. So they better lend it to someone, another bank, who, is short of funds, right? So they will do that. All right, but but you can think this way, right? It's an actual market interbank between banks. So how can the Fed influence if it's it's the banks that are exchanging funds from each other, right? There are a few ways here. So one is open market operations. They can buy or sell short-term treasuries to add or remove liquidity from the market. Okay, they can also set interest rate on reserve balances, right? They set the floor by paying banks a risk-free rate for holding reserves. They can do that. And the third way would be using repos and reverse repo. Repo means repurchase, right? So you sell assets, usually bonds, government bonds, to another bank or another party, and with a repurchase agreement already set in, right? So you will it's short-term collateralized borrowing lending to maintain the target range. By doing this, they can kind of manipulate and get the rate to where they want to be. All right. So because they have this power and they're such oversized player, the market will listen what they say. Right. So they will, there's the policy tool is that during these meetings, every FOMC meetings, the Fed's going to set a target range. All right. For example, 5.25 to 5.5, and users it uses these operations to keep the effective rate within range. All right. So they will announce what's the range, their target range, and the entire market will follow. Okay. All right. So here's the thing, right? Because interest rates is only make sense over a period of time, right? You can't that doesn't make sense to say interest rate is X if you're not talking about its time dimension, right? So there's a time component here. Since the Fed funds are overnight rates is very very short term, just one night, how can this rate influence what's going to happen for uh, longer tenors here, like 10 years, 15 years, 30 years, right? How can one day affect 10 years, for example, right? Okay. Um, what happens actually is this, right? Because you can think this way: 10 years is a set of 1 days, right? So number of 1 days here, right? Added together, right? Compounded over this time period. So it's the expected path of Fed funds. All right. So today, let's say today the Fed rate is at this level, but if you aggregate and day by day for a period of entire period of 10 years, you'll get the 10-year rate. Okay. But since we don't know what the future is going to be, it's based on expectations of future interest rates and the expected path of Fed funds, right? That's what it is, right? And of course, inflation projections are gonna help you determine this path, right? Because it's the Fed funds rate is depends on the policy, the Fed policy, which in turn depends on inflation expectations. All right, and of course, there's a term premium. The longer you are, the farther in time you are from from today, when you're making the projection, there is a term premium for error, right? It's also compensation for someone holding longer debt, right? So okay, also demand and supply for treasuries. This is really important too. So for example, if the country has, like right now, a big deficit, and foreign buyers are, shying away from buying it, this will also affect the longer end of the curve. Okay, but the yield curve connects these rates, right? It's like this. So usually the shape of the curve, the yield curve, this is what we call yield curve. The yield curve is typically upward sloping, typically when the economy is healthy. When the economy is in a recession, for example, this curve is more likely to be downward sloping. All right. So short end rates higher than long rates. All right. So short rates greater than rates. But here, in this example, when the economy is healthy, right, a good economy, it's a growing economy, um, it's upward sloping. Okay. And as we said, the short, very short end is controlled by the Fed, and the rest of the curve is controlled actually by the market. Okay. All right. So, yeah, just as we said, how Fed funds influence the yield curve. When the Fed raises Fed funds, short rates go up, right? And tends to pull the short end of the curve. So, this end here, right? And long rates usually move in the same direction if markets believe the Fed will succeed in controlling inflation growth. Okay, one second. Okay, so there is a transmission mechanism. You can think it that way. Higher Fed funds will lead to higher bank funding costs. Oh, one second. Tighter credit, slower economy, lower inflation expectations. And that will lead to eventually lower long-term yields. Give me one second. Let me just recover from my. Okay, sorry, I'm back. So higher Fed funds rates, right? You increase the funding cost, not only for banks but for the entire economy, right? And then, of course, the economy tends to slow down with lower inflation expectations. Eventually, uh, the long-term yields are going to come down. All right. So basically, what happens is by just affecting the very short end of the yield curve, you will influence the rest of the curve. All right. So that's the goal here. All right. So the Fed will control the short end, but the market controls the long end. But the Fed is trying to influence what's going to happen with the rest of the curve. Okay. Okay. So I'll give you examples. One example when it worked, the transmission was successful, and one example when it did not work, the transmission failure, for example. Okay. Okay. So this is 1981, 1982. The Fed president was, the chairman was Paul Volcker. Uh, the Fed hiked Fed funds aggressively, over 15%, my goodness, right? To crush inflation. That was in the early 80s. The long term yields eventually fell as inflation expectation collapsed, right? So it worked. You see, they tried to, they hiked the short end of the yield curve, right? But the long term yields eventually fell, right? It wasn't immediate, but as inflation expectations collapsed, they fell, all right? So the result was normalization of the yield curve over the next few years, and it's the start of a 40-year bond bull market, right? For the bond market. Okay. Okay. So actually, this We haven't seen this totally yet, but it's forming right now. It looks like it's not going to work because the Fed has been hiking um, and holding later, right? Short rates higher for longer. That's what's happening right now until the last meeting. They started cutting 25 basis points. But long-term yields rose sharply in 2023, despite Fed nearing end of hikes. Of course, that was driven by rising U.S. fiscal deficits, more supply of treasuries, reduced demand from foreign buyers, China, Japan, and other countries diversifying, right? And concerns about U.S. credit rating and debt sustainability, right? So, especially foreign central banks are demanding less treasuries of longer term treasuries, like here, as this illustration here. Okay, so the treasury bills are very short end, up to 2 years, right? Then treasury notes from 2 years all the way to 30 years, and 30 years and above, we call them T bonds, right? So it looks like from the more recent auctions that most of the financing are happening here and not here and here. So demand for longer term uh, U.S. Treasury assets is lower today. Okay, so they're being financed over here. This is not very good. Okay, so that will, for example, right now the president wants to reduce interest rates, especially long term interest rates. But what can they do? This is controlled by the market. It's not and some politician wanting to change it and change it magically, right? It can't change it like magically. So what they can do is the Fed to cut rates. It will affect the short end, but this really depends on other factors that the market that I'm sorry that the government cannot control. Okay, and these things depend on fiscal deficits. You need more treasuries, and you need more buyers of your treasuries. And if you don't find this demand, you may have a problem in the long end of the curve. All right. Okay. So that's the problem. All right. So key takeaways for investors: the Fed controls the front end, but markets control the long end. Okay. Normally, Fed policy guides the whole curve, but in times of fiscal stress or inflation anxiety, which is exactly what's happening right now, the long end can go rogue. Okay, this means lower Fed funds doesn't guarantee cheaper mortgages or corporate borrowing costs going down. Okay, and investors should watch long-term yields and term premium as much as any Fed announcement. Okay, keep an eye. Okay, how can you find out what market is expecting for the future trajectory of the Fed funds rate? Actually, if you never seen this before, there is a market. Okay, the Fed funds futures market at CME. Why does a market, the existence of a market, it makes the information that you collect from the market so much more reliable? It's because if you have some expert coming out and say, well, I think the Fed rate is going to go from this point to that point, right? Okay, it's his opinion, it's his projection, right? Whatever he's using to make that projection, you don't know. And again, talk is cheap, right? Anybody can say things. But if there's a market, people are betting real money in there, right? Money is where their mouth is. Okay, so prefer to get information from a market, not from someone saying things. All right, talk again is cheap. All right, anybody can say anything. All right, but in the market, his people are still, they believe, they have their beliefs. Some people will think, well, the rate's going to go up. Other people think the rate's going to go down, just like the stock market, right? Anybody can give you any information, any projection about what they think is going to happen the with stock prices. Stocks are going to go up, going to go down. Well, who knows? Maybe, right? Maybe some people will be right, some people will be wrong. But the best place to get information, reliable information, is directly from the market. All right, that's where people are betting real money in it. Okay, so there is a market for Fed fund futures, which is why futures, right? So they're betting the Fed funds rate at future points in time. Okay, so that's why there's a few Fed funds futures market. All right, this is the link, or you can just Google CME um, Fed Watch tool. Okay, CME Fed Watch tool. This is what you'll get. All right. So basically, what you're gonna get, they're gonna show you the probabilities of future Fed interest rate targets from that market. All right. So you have like target rate ranges and what the market is implicitly through their trading showing us what the thinking of the market is in terms of probabilities. Okay. So, for example, today you see this picture. Uh, just an example. If you see this picture, you'll think, well, there's a 55% chance that the Fed is going to be here. All right. Higher probabilities, the others is kind of more unlikely to happen. Okay. All right. This screenshot I took yesterday, last night. If you look at this, these are each of the futures, okay, that goes into the future. And those are the prices that they're trading for the Fed fund futures. But you don't need to know that because the tool already calculated the probabilities for you in this table here. So how do you read this? Simple. So if you see a little ladder like this, it means that it's cutting rates. It's going this way. If it goes to the opposite way, to the right, it's um, it's hiking rates, right? So here they're cutting rates. So okay, next meeting is going to be October 29th, right? The probability that it will be between 375 and 400 basis points. Okay, here basis points. So you can think 3.75 or 4%. Okay, 94%. So market is really expecting a cut here. Okay. Um, and next meeting in December, here are the probabilities: 76.9% of another cut, or they will hold with 20% chance, or if they can still keep here, 1.1% only, right? And so on and so forth. So you can look at this figure here and you say, oh, wait, okay, I can see now what the market is projecting for the future in the near future with what's going to happen. Of course, this is a snapshot of what the market is thinking last night when I took this screenshot. Today, it's going to change. All right, all the time. There's changing because there's a market, and it will change all the time. All right, it gives us an idea. All right, so how do you read this? Right, um, it converts Fed funds future prices into probabilities for the next Fed decision. For example, for this one here, right, you have a 70% probability of no change here, 25% of 0.25 hike, and only 5% for a 0.5 hike. Okay. The highest probability outcome is what markets expect today, but this can shift quickly. So there's an example: April 9, April 10. See how the perceptions changed. Okay. Just to illustrate that this is not fixed. Okay. And what's the reliability of these probabilities? Actually, is very reliable, especially in the short term. All right, like the next meeting is very, very reliable. Okay, by experience, I can tell that. Um, Markets tend to price in Fed decisions well before they happen. Remember, I said that the Fed doesn't want surprises, right? So the market, of course, will get that information and price in, so it will be reflected here. That's why the next meetings is very reliable for that meeting. Okay. However, probabilities are not fixed. They move daily as new data arrives. Okay. When you get new CPI, jobs report, GDP, right? Those numbers may affect, will affect, investors' perceptions of how the Fed's gonna implement policy going forward. So big surprises like hotter than expected inflation can flip expectations overnight. Okay, leading to volatility. So it can change overnight really quickly. Okay, so how investors should use this data? If probabilities show near certainty of a pause, and the Fed surprises with a hike, there's going to be a market sell-off. The market's going to react immediately and strongly. Okay, that's why the Fed doesn't want to surprise us. Okay, so if probabilities show high odds of hikes, but the Fed signals dovishness, right? It want to do, it's not as aggressive as the market thought. The risk assets are going to rally. Okay, so watch not just the probabilities, but how they change over time. Okay. Okay. So here's just a historical perspective of the Fed funds rate. See here in the 80s, it went almost to 20%. It was like huge. All right. So and look at here. This is the 2010s. 20 during the 2010s, 2010 to 2015. Look how low the interest rates were. Inflation was very low. People even forgot to take inflation into consideration in their spreadsheets, right? For a long time, we just accepted, well, there's no inflation in the United States. How awesome is that, right? Okay, but that changed, and um, the Fed started hiking rates, and then came the pandemic. It went all the way down, and they started hiking again. Let's talk about that. Okay, here is someone saying, is an accommodative Fed? What's accommodative Fed? A Fed that's easing, okay? That's easing, not tightening, but easing. Is that bullish for the stock market? Well, the conclusion is quite the contrary. I'll show you it's not exactly this, okay? But this is what the person who created this chart is saying, right? So if you just look at the charts, what you can see is it will, it will give you the impression that the market, this is the S&P 500. Okay, this is the S&P 500. The black line and the blue line is the Fed funds rate. Okay, so during this period, the early 2000s, the the Fed cut the rate 13 times from 2000 to 2003. Of course, here we had the internet bubble, 2000 internet bubble, right? And market, the bubble burst, and the market started selling off here, right? Went down 51% during this period. And if you look at this, say, wait a second, look here. The 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 Fed's cutting rates, and the stock market going down. Hmm. All right. So they're easing. They're they're easing. It's not really it's not um, a tailwind for the market. And here again, in 2008, looks like, you see, the Fed's cutting rates and the market is tanking, tank cuts, right? And here, the the Fed is increasing and the market's going up, 57% up. So, but the big question here is, who is is this the egg, chicken, or the egg? What is causing what, right? Okay, I'm gonna show review in a minute. Actually, the best analogy I could think of is like two tanks. Okay, so tank number one will receive water. Let's say that we start with both tanks empty. Okay, so the first, you start filling up tank one until the level of water inside tank one reaches this level here. Tank two didn't see anything, right? Didn't receive any water, right? So you gotta fill up the tank one first, so the excess water will be flowing to tank two, right? So what I think is happening is that, you know, until you get tank one filled, tank two won't even know tank one is being filled, that you have water coming. I think it's the exact same thing here. Okay, so um, you're hiking interest rates here, right? You're hiking interest rates. The market keep going up because you haven't achieved critical point yet. When you it achieved certain point, that triggered the market to go down, and then the Fed. Remember, we said the Fed is always behind the curve. The Fed is not the chicken, it's the egg, right? Because then the market started going down. Then the Fed said, hey, wait, we have to cut rates. Oh my God, let's cut rates. Okay. So it's not that the market is causing the Fed. It is the market causing the Fed, but but the problem was caused by the Fed in the first place, right? Because it may give the impression that, wait, where the Fed is increasing the rate, and that's good for the market. Not really. The thing is that until it reaches certain critical mass here, the market won't turn around. Okay. All right. So let's see what happened, right? So this is the picture. During this period, we had the 2000 crash, the 2008 crash, and the 2018 crash. All right. And we can see what happened with the Fed here. What the Fed is doing is the blue line, and the red line is the S&P 500. Okay, so let's focus on this one first, right? This is the 2000 crash. We already talked a little bit about it, right? If you see the details, look, from early 1992, 1993, the Fed funds rate was at 3%. It went up, right? It went up. That was, I think, was Alan Greenspan at the time, the Fed chairman, right? And then it plateaued at 5 for a while, for a few years, and then started increasing again, and then the stock market started selling off. Okay, that's what Alan Greenspan called irrational exuberance at that time period, because he was hiking rates, and the stock market kept going up until a certain point was reached, and then the market started selling off. Okay, and then the Fed immediately said, "Oh wait, we overdone this. Let's reverse policy." They reverse policy over here. Okay, all right. During that time, of course, every time is different, right? The context, the circumstances are not the same. So here for Alan Greenspan in the 80s and 90s, the inflation was between 0.5 to 4.4%. GDP growth was 1% to 475. The chairman was Greenspan, and the president was Clinton and Bush administration, right? Both administrations during this time. What happened in 2008? 2008, as you can see here, if you look at with a magnifying glass, okay, so 1%, the Fed fund rate from 1% all the way to 5.5, okay, and then the market started reversing, and then the Fed, same story, okay, reversed policy. Okay, 35% and 57%. This was the great financial crisis, okay, 2008. Okay, that time inflation was minus 0.3 to 4.6. The GDP growth was negative 2.5 to 3.8. Fed chairman was Bernanke and President Bush at the time. Okay. How about the 2018 crash? Almost like the same thing. Look at this, right? Fed funds from almost nothing, it was hiking to 2.4%, right? And the S&P 500, while it was hiking here, it kept going up. Didn't care, right? And then 15% down. Wasn't a great big crash, really like a big correction, but not really a crash, right? That time, the inflation was 1.45 to 4%, GDP growth between 1.7 to 3, and Fed chairman was Yellen and Powell, and the presidents were Obama and Trump during that time period. Okay, so then we came to 2021, and here we got the pandemic, right? So here, the coronavirus crash right over here, and it recovered really, really fast, right? So the rate was already low. Um, it went to pretty much zero, 0.1%, right? Pretty much zero. And but what really fueled this growth is not really the interest rate because it was already kind of low. What did is the second mechanism. We're going to talk about it today, which is the liquidity. The Fed injected a lot of liquidity, a lot of money, a lot of stimulus money in the market, a lot of cash in circulation. So, and found their way to the stock market, fueling its growth, explosive growth. All right. I remember vividly at that time, someone called me and said, "Hey, Sydney, there's no good things to invest today. There's no good things." And I understand because we are here, 2019 to 2020, right? Early 2020. There was a lot of uncertainty. People didn't know what's going to happen next. If this pandemic is going to be contained, there's no vaccine. Nobody knew exactly what's going to happen. So fundamentally, if you are a fundamental analyst, you'll look at this and say, well, no, it's bad, right? It's bad. There's no, just like she said, there's no good alternatives to invest today. And I told her, I am bullish. Really? Yeah. Because what? Because there's just too much liquidity in the market. All right. So forget about the fundamentals. That alone is driving this recovery. Okay. And it was coming at a very fast speed. All right. And we made money over here. Okay. All right. The lot. That inflation was one to 7, GDP minus 9 to 12, minus 12. Of course, it's a huge, right, downturn here for growth. Uh, Powell was already the Fed chairman, and it happened during Trump and Biden. Okay. So at that time, we're thinking, well, how many hikes are going to happen, right? 4 hikes, 6 hikes, or 8 hikes to 2%. Well, actually, what happened was a lot more. Okay. This is incredible growth. All right. So the Fed really hiked rates here. Powell was accused to be slow, but anyway, because the market's already tanking here. All right, you see, even before he started hiking rates, the market is already on its way down. All right. So what happened next? Powell just increased the rate like crazy, and the market just went up. The market didn't care. And then he cut a little bit, right? Last year, cut a little bit, and the market also didn't care, right? Okay, and then there was Liberation Day here, has no correlation with with Fed rates, all right? And right now, nowadays, it keeps going up, and the Fed's cutting here. Oh, what's going to happen now? Interesting. So, conclusions. It's impossible to predict exactly when adverse events like correction, crashes will occur, right? Past experiences may not represent exactly what's going on, what's going to happen this time, All right, because the conditions are not the same. We just saw, right? Every situation, where you had the Fed hiking rates and the market responding, or the market moving and then the Fed responding. It's the conditions were not the same. Not the same GDP, not the same inflation. There's a lot of things happening. So what do you do in a situation like that, right? So what you need is a risk-based system versus a price-based system for investment decisions. You need a risk-based system. Daily measurement of risk, daily decisions, and it must be simple to use and easy to use, right? It shouldn't take too much time. It must enable quick decision detection of trouble and to seek safety early, all right? So the risk 500 risk indicator is a solution. We're going to talk more about that. All right. Okay, remember we said that, right, all the time until now, that the Fed funds rate targeting is one of the instruments of monetary policy to control interest rates. But the Fed has another instrument, which is the balance sheet. The M2 is money in circulation in the economy, right? So what are QE and QT? QE is quantitative easing. It's a monetary policy tool in which the central bank buys long-term securities, treasuries, mortgage-backed securities, to inject liquidity into the financial system. What happens is that the Fed, or the central bank, is going to buy securities from the market and put in their own uh, balance sheet. If they do that, they're basically buying the assets and putting money, cash, in the market. So it increases the Fed balance sheet, but also injects cash into the economy. M2, more cash, right? That's what happened in during COVID. They injected trillions of dollars in the economy. Okay, the Fed pays for the assets by creating reserves, crediting bank accounts, thereby increasing the size of its balance sheet and overall liquidity in the market. Okay, what the goals? Push down long-term interest rates, making borrower cheaper. Right, just easing. Right, as we call it, quantitative easing. Um, you can say it's printing money. All right, that's another way to say it. Printing money. Pretty much what they're doing is printing money. All right. Um, of course, this will encourage risk taking because you have more money in circulation, right? Of course, these people are gonna, as I said, right, a lot of this money found its way to the stock market, right? And credit too, because banks may lend as well, right? Lend at lower rates. You are stimulating the economic growth when conventional rate cuts are exhausted, right? Remember in 2020, we're already at 1.5%. So you reduce that effect is going to be minimal, right? Because you're already a very low rate, pretty much 1.5 to zero. It was 0.1 to not say zero, right? Okay. Okay. Quantitative tightening is the opposite, right? It's the reverse. The Fed reduces its holdings of those securities or allow them to mature without reinvestment. Okay. So they're not holding those um, from the market anymore. All right, they're not buying from the market. All right, they can even sell. All right, by doing so, the Fed withdraws liquidity from the system, tightening financial conditions. The opposite, it's going to reduce its balance sheet and going to reduce the amount of money in circulation in the economy. All right, so this tends to raise long-term yields because there's less money in the system. The the cost of money is going to increase, right? So that's why yields are going to go up. All right. This is not good for risk asset valuation. Okay, we already talked about that. Um, Examples when QE and QT were used. So QE examples, post 2008 financial crisis. There were three QEs, one, two, and three. Right, the Fed bought trillions of dollars in treasuries and MBS, mortgage-backed securities, to support credit markets and stimulate growth. And during COVID, just as we said, right, was a massive QE, massive, huge, trillions of dollars, right? And QT, 2017 to 2019, that's when the Fed started scaling back, right? This is a problem because when they do QT, the at the beginning, as we saw those charts, right? It doesn't happen. Nothing happens at the beginning, but until they reach a certain level, you will, you know, tip off the market to the other side. So the market started to sell off. Okay, 2022 onward, yeah, since 2022, because of high inflation, the Fed started uh, actively reducing his holdings. So basically, they're doing QT. Okay, all right. So as of recent months, the Fed has reduced the balance sheet by over $2 trillion from the peak. Okay, so we are already in this regime. Um, how QE, QT affect interest rates and the economy? QE, quantitative easing, lowers long-term yields, right? And quantitative tightening raise yields. Okay, we already talked about that. We don't need to go through all this. Okay, so this is just an illustration so you can see what really happened. When the interest rates are going up, QE, QE, quantitative easing. This is the balance sheet of the Fed, right? So if the balance sheet is going up, means that the more money is released to the market, right? Then you have a financial crisis. They reverse course, right? So this is after the 2008 financial crisis, right? Interest rates are very low and inflation are very low, right? So they did this quantitative QE1, QE2. You're in good times, and then you got here 2020. Oh my goodness. 2020 right here, this point is when COVID hit, right? So the government got desperate. What do we do? What do we do? They started doing quantitative easing. Um, you know, interest rates to zero and trillions of dollars in the market. That's pretty much what happened, right? So the years of the pandemic, all this money, trillions of dollars, right? We're below 1.5. So we got above 2.5 here, trillions. And then, of course, you have so much money in circulation that caused inflation, right? So inflation came, and then they just reverse course. So let's do quantitative tightening now, right? So you have to rise, raise interest rates to combat rising inflation, right? Okay, that was caused by excessive liquidity in the system, too much QE, right? Too much QE here caused inflation to go up and then interest rate to go up, right? Okay. Second part here, we're going to talk a little bit about the Fed speak, right? Got to understand how the Fed communicates with the public and how we can turn those words into signals for us investors. Okay. So the Fed's most powerful tool actually is voice. They didn't need really to do much. Just what they say will affect how markets behave. So the Fed doesn't just change rates, it guides expectations with language, right? This term, forward guidance, is used to prepare markets for future moves before they happen. Remember, we said that the Fed is going to telegraph to the market to avoid before the meetings, before the decision release, so the market can get ready, prepared, right? Okay, so that's the reason why it's called forward guidance. Often markets react more to what the Fed says than what it actually does because they say it first, then they do later, right? Okay, for example, December 2018, Powell signals patience. You use the word patience. And the market interpreted this word patience, meaning that he's going to hold for longer, right? So market rally sharply after brutal Q4 sell-off. All right, I think it was October, August 2022, at the Jackson Hole meeting, Powell said, paying for households and business. That speech triggered a steep sell off. No rate hike was even announced. All right, just by what Powell said, okay, the market interpreted what he said. So that's what I call Fed speak or Fed talk. Okay, so common, just so you know, the common Fed jargon, what it really means. Okay, so the term hawkish means fighting inflation. They're focused on fighting inflation. All right. So the implication for the market is when they're hawkish, it's bad for risk assets, higher rates ahead. Okay. Dovish is the opposite. It's focusing on supporting growth, so like easing policy, and it's good for risk assets. They may also say data dependent. When they say data dependent, means that they are waiting for more data, right? I'm not sure. I'm not sure what I'm going to do. I need to see more data before I make a decision, right? That's pretty much what they mean. Market is can be choppy until you are more clear what's going to happen. They may also say higher for longer. Higher for longer means the rates will stay elevated for an unforeseen period of time. All right. So that will may cause lower growth, pressure on stocks. Um, soft landing. What soft landing means? This is a term that's very often used. It means that inflation is going to go down, but no recession. It's going to land softly. Okay, it's not a hard landing. You can say hard landing is the opposite. Hard landing is like, you know, you're bringing inflation down with a hammer, boom, down, right? So that's a bad case for markets, of course. Terminal rate. What terminal rate means? It means that the peak Fed funds rate. So this you have to watch very closely. It may mean that's the end of hikes. Like they're going to their, let's say they're hiking. When they talk about terminal rate, it may be telegraphing, telling you that they're gonna end there. All right. Okay. Key sources of Fed communication. You have the FOMC statement, of course, the dot plot. I'm going to show the dot plot in a minute. Press conferences, right? Speech interviews. This happen all the time. And the meeting minutes is very important. So all these communications are going to be dissected by the market. All right. Okay. So just an investor checklist. How to read Fed talk. You have to compare with the last meeting, because they're going to send, for example, they're going to publish their meeting minutes from last meeting, so you can compare with the previous meeting and see what words changed, right? Sometimes, for example, there's a word strong became moderate. That gives you a sense of their thinking, right? Listen for the tone as well, right? Is it hawkish tone or is a dovish tone, right? So you can get from the overall document you know, are they more concerned about the jobs or inflation, right? You can get that clue from their language. Watch for triggers. Sometimes they will say further hikes may be needed. Oops, okay. Versus policy is restrictive enough, so maybe they will stop what their hikes. Okay, and cross-check data. Right? Do jobs and CPI reports support what they're saying? Okay, and watch market reaction. Bonds usually move first. Yields up, hawkish. Yields down, dovish. Right? Okay. Um, take another takeaway. The Fed talk is a map of where policy is headed. So it's very important. If you decode it early, you can position your portfolio before the big moves, ahead of other players. Okay? Think of it as a GPS for risk, telling you when to rotate into or out of equities, bonds, or cash. It gives you a general direction what may happen. Okay? All right. Okay. So let's give some example here about the Fed talk. First example, December 2018, the the Powell was going to pivot the market, right? So the context is in 2018, the Fed had been steadily raising rates to normalize after years of QE, right? And by the fourth quarter of 2018, markets were panicking. The S&P 500 dropped almost 20% in just 3 months. What Powell said in January 2019, he signaled the Fed would be patient with future rate hikes. So basically, it's not going to do anymore. Uh, Market reaction, investor breathed a sigh of relief. The Fed pivot sparked a sharp market rebound. Okay, so the S&P 500 went on to rally more than 25% in 2019. So, lesson for investors: the Fed tone changes can mark major turning points. Spotting them early can capture huge upside. All right. Okay. Example two, August 2022, Jackson Hole paying speech. That's when they use the word paying. All right. So the context was inflation at 40-year high, 8%. And the markets were hoping the Fed would soon pause rate hikes. Please, please, please don't hike anymore, right? The market was like hoping. And the stocks had rallied in the summer of 2022, expecting a pivot. But what Powell said, he warned of some pain for households and businesses as the Fed fought inflation, rejected the idea of near term easing, confirmed higher for longer. Oh my God, right? Market didn't like it at all. So the immediate reaction was a sell off. The S&P 500 fell nearly 6% the next week. Bond yields jumped as market repriced expectations for more hikes. All right. Didn't do what market wanted. All right. So the lesson for investors: when Fed explicitly signals pain is coming, ignore it at your peril. The market will react. All right. Okay. Example number three, March 2020. That was during the pandemic emergency actions. The context: COVID-19 triggered a sudden economic shutdown, right? Markets were in free fall. The S&P 500 dropped more than 30% in just weeks. Credit markets were freezing. Okay, what did the Fed did and said? Announced emergency rate cuts to near zero. Right, it's even before the next meeting. Right, outside the regular meeting was so desperate. You gotta do it really quick. They didn't even wait for the next meeting. Right, they just announced, okay, we're gonna cut. That's it, and we're launching an unlimited QE. Right, quantitative easing. They're gonna buy treasuries and mortgages from the market to print money. Pretty much, we're printing lots of money. Let's flood the market with money. Right, and pledge to use its tools forcefully. This is the word that they use: forcefully, proactively, and aggressively to support the economy. So, hey, these things are coming, right? Unlimited QE and rate cuts to zero. Okay, the market reaction, the panic just reversed. March 23, 2020, the bear market bottom. The S&P 500 surged more than 70% over the next year. Lesson for investors: Fed reassurance can mark a generational buying opportunity. Hey, there you go. Liquidity drives market. All right. Okay. So sometimes you're thinking about fundamentals of the companies. Is this company good or bad? Stocks good or bad? But there's other things that you are not seeing, which is the liquidity in the market. So there's a lot of cash chasing assets. Hey, asset prices are going to go up, right? Okay. All right. So in a nutshell, right? So Fed speak decoder. Hawkish. What hawkish means: focus on fighting inflation, bad for risk assets. That's market implication. We already saw that. This is just a illustration for you. Okay, visual. All right, cheat sheet. All right, examples of Fed talk: December 2018, right? Patient shift, the word that he used. Uh, Forcefully, proactively, and aggressively, unlimited QE, near zero rates, right? and paying for household and businesses, right? So, okay, and then you see the market reacts very violently to the talk, all right? All right, so you can use, this is another cheat sheet here using the Fed signals as an investor, right? So you identify the cycle stage, if it's tightening or it's easing, right? Then you assess risk and opportunity, right? More tightening, more risk for stocks. Easing, you have this risk here of too much liquidity, right? Then you can position your portfolio to be risk off or risk on. This is something that you can do, all right? Okay, but there's always a but, right? Reading the Fed is a bit more nuanced than that. Oh, right. Because in certain situations, bad news may be good news can be bad news, and vice versa, right? So let's give us some few examples here. So, example number one is a situation where weak jobs will make markets rally. It's kind of, it's the opposite to what we would expect, right? So if employment is bad, the market should go down, not rally. Well, depends, because there are certain situations bad news is good news. All right, so let's explain this. It really depends on the context. All right, context. All right. Periods when the Fed is perceived to be nearing the end of a tightening cycle, for example, and markets are on edge, watching economic data closely for signs of deterioration. So, what happened? In August 2025, the payrolls report came in at just 22,000 jobs, far weaker than expected. So, this is a bad news, right? But such weak print reinforced expectations that the Fed would move quickly to cut rates in upcoming meetings. In the immediate aftermath, short dated treasuries rallied as market repriced rate cuts. All right. So the thing is that this is the bad news here will make the Fed to act, and the market expect the Fed to act to cut rates, and cutting rates is good for the market. Okay. So you have a bad news which may turn into good news, right? Because the Fed is in here. All right. Okay. Interpretation. Why bad news? You go quote good news in this case. The weak labor data is negative for the economy, but markets see it as adding firepower, more reasons for the Fed to ease. Okay. The expected rate cuts lower discount rates and increase liquidity, which benefits risk assets and bonds. All right. So essentially, bad news shifts to expected prop policy path in a favorable direction for investors. Okay. Example number two: inflation surprise or cooling. Market react positively because it signals easing. Right. It's almost the same, but this is for inflation. Right. So same thing. Inflation is should be bad for the market, but it will react positively because it will signal, easing to the investors that the Fed's probably going to ease. All right, I'm not going to read all this, but you got the idea, right? So sometimes bad news is good news, right? Weak job data, that was August 2025, right? The context was the market expected rate cuts, and what happened was the payroll came very weak. But then the market thought, well, weak labor report, probably the Fed's going to cut. More reasons for it to cut. Plus Donald Trump's pressure on Powell, right? And inflation surprise, right? Same thing. Okay. So this can happen as well. So be careful here. All right. So it's not direct. It's not just apply this, and it's no. You gotta consider the context. All right. Okay. All right. Let's talk a little bit now about the Fed put and the third mandate. All right. So what's the Fed put? Right. So it's very common in the market that that there's a put option that protects investors from downside. Well, in a nutshell, I'm not going to really read this, but you can, I'm going to explain it. Like, if you think about it, um, in the U.S. is a little different from, it's not only a little, it's a lot different from many many countries in the way that um, the equity market, stock market here, huge. It's huge, and it's a very financialized economy. The U.S. economy is very financialized. Um, More people, in percentage terms, compared to other countries, as much more individuals, peoples, and families that invest heavily in the stock market. In other countries, it's not the same, right? Most countries, it's not the same. So, especially a lot of people have their um, retirement accounts uh, pretty much stocks, most very composed of stocks, right? So if the stock market goes down, it will affect a lot of people, but not only regular people, but especially the wealthy in the country, and big investors like funds and institutional money is in the stock market. So, um, because of that, um, the Fed is very has a incentive to do that, to support financial markets if they fall too much, right? Too much or too fast. So the investors came to believe that the Fed will always rescue them. Okay, so if the market goes down by a lot or too fast, investors assume that the Fed's going to come to the rescue. All right, so it's the meaning of Fed put. All right, okay. So why the market believes the Fed put exists, right? Because history supports it. In 1987, after Black Monday crash was 22% down in one day, Alan Greenspan at that time pledged to provide liquidity, and then the markets stabilized. The 2008 great financial crisis, the Fed slashed rates to zero, launched QE, and bailed out major financial institutions, major banks, saved them from collapse. In 2020, the pandemic, right? During the pandemic, the Fed cut rates to near zero and launched unlimited QE, right? So if you do these things repeatedly, several times, the market will start to believe there is a Fed put that's not written anywhere, but the Fed is going to do it, right? So that becomes a pattern, right? So the Fed is going to always come in to to help out. Well, is it true? We don't know. It's not a mandate of the Fed to do that, right? But they've done this in the past. Okay, all right. So this is an example of the Fed put in action. March 2020, the pandemic. The S&P 500 fell over 30%, right? So on March 23, 2020, the Fed announced unlimited QE, and the market bottomed that day, right? So, and there is also the unspoken third mandate, because we know officially the Fed has two mandates: price stability, inflation, and maximum employment. But in practice, there's a third mandate, um, which is financial market stability, right? If they're coming to the rescue of the market, because they don't want to become a contagion to other markets and cause a panic. So they will act, they will do things. Now the question is, the does the Fed can do this, was able to do this until today, because the US dollar, is the hegemonic currency of the world. But the dollar is losing strength, okay? Because of the dollar, the US could always rescue its market and save its economy, and by exporting their problems to the rest of the world. But as the dollar loses strength, the ability for the Fed to do this, it's diminishing. Okay, so is it guaranteed that in the future the Fed's gonna come to the rescue all the time, every time? That's not so sure. Okay, so we got to think about that because there's things that are changing. It's not like, it's okay, yeah, just repeating the past. Sure, don't worry about it, right? Okay, all right. Um, what are the risks of over reliance? There's a moral hazard. Investors take more risk assuming the Fed will always save them, right? It can create, that's why it's so easy to create asset bubbles, right? Okay. So we are locked into the cycle of boom and bust all the time. Okay. All right. The key takeaway here is that the Fed put is real. History shows that the Fed will act to stop systemic collapse, but it's not a guarantee. No guarantees. All right. Sometimes they won't and not be able to, or they just change their stance. No, I'm not going to do this anymore. We don't know. Right. So if inflation is tight, the Fed may let the markets fall. Right. Let it fall. Let it correct to restore price stability. Right. This is a one way to solve this problem. Right. So maybe they will not save. All right. Okay. And understand this third one mandate helps investors know when liquidity support is likely and when it isn't. Okay. All right. Okay. Let's learn how to interpret the Fed's dot plot. This is a dot example of a dot plot. All right. Dot plot. We have several dots here. How to read this? Okay. Uh, each dot is one FOMC member's projection for the Fed fund rates at the end of each year, okay, and longer term. So they're gonna, each dot here is someone sitting in the FOMC, and they're projecting what they think is gonna be the rate this year, next year, and then longer run, right? The dots are anonymous. You don't know which member is which. You don't know who has this such view, okay? And the chart shows the current year, next 2 years, and longer run. Okay. Step two, look for the median dot. The median dot is the most important. It reflects the consensus of the committee. Compare the median dot to the current Fed funds rate, right? If it's higher, it means more hikes expected. If it's lower, cuts are expected. All right, so you've got to see what's the median, where the median is, and compare to the current rate. All right. Example: if the current rate is 5.25, and the median dot for the next year is 4.25, markets expect rate cuts next year. Okay, simple as that. All right. So you pay attention to the shift over time. All right. Is this dots moving up or down? Right. Okay. If they're moving up, it's more hawkish, down, more dovish. The change is often more important than the absolute level. Okay. For example, June 2023 versus September 2023, dots move higher, signal rates would stay higher for longer, and so the bond yields jumped and stocks sold off. All right. Okay, and cross check with market pricing, right? So you can look at the Fed watch tool, the CME, the CME Fed watch tool, right, to see how markets are pricing those expectations. You can cross this information from the dot um, plot to the CME Fed watch, okay, and see what happened, right? So here's just an example, all right. So how can you use this this information here? All right. So, but the major takeaway here is that if markets had priced something, like in this case, like only 50 basis points of cuts, this dot plot would be a bullish surprise. Okay. So the stocks will rally and long bonds will rally too. Okay. So it's really like, seeing what the market has priced in, which you get from the CME Fed watch, and what the Fed is showing here, what their rate projections are. All right. Okay. Okay. So key points: don't overcomplicate it. Focus on the median dot and direction of change. All right. Dot plot is a forecast; it's not a promise. All right. But market trade but markets trade on expectations. It's most useful for anticipating the end of a hiking or cutting cycles. All right, market inflection points. Very well. Okay, we're coming to the end. Okay, so this is another belief in the market. Okay, that oops, sorry, oops, that the every time the Fed pivots, like here, 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 and here, changing direction, and will cause a bear market. All right, so here was a Fed pivot, came down, another here, came down, another. Okay, so that's the belief. This is the Fed funds effective rate, right? Okay, every time it turns around, it seems to trigger a sell off. Actually, I think it's the opposite. It's a sell off, then the Fed funds effective rate comes down. All right, but anyway, so the Trump pressure to cut rates right now, right? So the Fed has just cut 25 basis point a few days ago, and the market believes in another 25 basis point in October, another 25 in December, plus two more in by July 2026. So clearly a Fed pivot. The thing is, the question to ask is, are we on the verge of a crash, right? So this is the question to ask. And if you look at the stock market prices right now, they're pretty high, right? They're pretty high. Oops, they're pretty high. But as always, you will find people who will make arguments for bull and arguments for bear, right? People believe it's going to go up and go down, and they were going to give you arguments supporting what they think, right? Their predictions. Okay, but the answer is I don't know. I don't know who's going to be right, who's going to be wrong, and I really don't care. I don't forecast. I don't practice futurology here, right? I only measure risk and I match the best asset for each risk level. Okay, so what we're doing here is a different type of, um, of looking at the market and acting um, to make money, all right, and protect our wealth. So I can beat the S&P 500 just by doing that, right? I don't need to know if it's going to go up or down. I just look at the risk, all right? So it's the risk. I want to get a return. Yes, return is dependent on risk. That's why I only look at the risk. That's enough, all right? So that has guided our results here, right? Our actions and the results are here. Speak for by themselves, right? We're beating the S&P 500 by a lot, right? Especially over the long run, okay? And the method we use is the Smigger method. In a nutshell, it's I can tell you just to summarize Smigger in a nutshell, right? The few words. It helps you. How does it help you determine when to buy and sell? Here's it. When the next incremental return is worth the next incremental risk, given my personal risk tolerance, I stay invested in a risk asset, right? So it's worth it to hold. I will hold. All right. In terms of risk and return, right? If I'm going to take a little bit of risk for a little bit of return, and that relationship is worth it, I remain in the stock market. Like today, for example, the risk is pretty low right now. Risk pretty low. So the return is not great also, but it's not bad, right? So I'm holding. I'm holding the S&P 500. I'm holding the other risk assets because the risk is very low. Okay, but if this relationship between return and risk, the next incremental return compared to the next incremental risk I'm taking, it's not worth it anymore. Given my personal risk tolerance, I know I must switch to a safe asset. It's time to sell. All right, time to sell, and don't think twice. Just sell it because the return is not going to compensate the extra risk I'm running. Okay, so that's the idea. That's the whole idea of the Smigger method. All right, measure the risk in the market. I use the risk 500 risk indicator to do that, right? So when the risk is low, the market risk is low, I invest in risk assets like stocks, ETFs, etc. And when the market risk turns right, too high, sorry, I invest in safe assets. I just switch. I rotate to safe assets like short-term bonds, gold, and cash, etc. Okay, so that's the mechanism. When the market risk goes low again, I will switch back to risk assets. That's all I do. All right. So the first goal is to avoid crashes and serious downturns. So, for example, one of my strategies, strategy number one, is just S&P 500 or cash, right? So if the risk increases too much, hey, it's the weather's bad, right? The weather's bad. I'm going to I'm gonna rotate to cash. That's it. Seek safety. But when the risk is low, I'm gonna hold the S&P 500. That's all. S&P or cash. That's simple, right? So this strategy from 2022 to 2023. So this was a bear market followed by a bull market, right? So the S&P 500 in 2022 went down 20 about 20%, down 20, ended the year with 20% down, right? But strategy one just avoided. Look, when the market went down, the downturns here were avoided. That's why you see plateaus here, right? Plateau because it moved to cash, right? So cash has no return, so zero return. Right here, zero, zero, zero. It doesn't move. It didn't move. You preserved your wealth during the serious downturns, right? Because this could go farther down, right? But the moment the risk, you know, uh, went down, it's good time to get back in. So we're back in the game again, right? So just by doing that, strategy one ended 2022 flat, right? Flat, right? And then 2023, look at this. It started the year ahead of the S&P 500. So someone just doing buy and hold, look how bad is as a strategy to buy and hold if you encounter a bear market, right? You're wasting time and money. This is the opportunity cost, right, for that person. Look at this, right? He will start with a 20% down here, whereas here I avoided all that and it was flat here. So I have a lead from here, right? So with a bull market, this gap starts to open up. All right. Okay. If you look at the drawdowns, this is even more impressive because the drawdowns of the S&P 500, the maximum hit like 25% during the period, 2022 and 2023. But look at the drawdowns of strategy one, so much smaller. What does this mean? More return, strategy one, more return than the S&P 500, but for less risk. Look, less risk, more return and less risk. Isn't this what we wanted? Remember, at the beginning of this presentation, I said that the goal of our club is to maximize the return over risk ratio. There you go. This is one of them. All right, that's the table. And with the risk 500, we averted past crashes. This is the coronavirus crash. When it crashed, we're sold here because the risk went above my tolerance for risk. All right, went above, I sold. Simple as that. The moment it crossed down here, I bought it back. And then the risk increased again, so I sold again, and then I bought back here. And I just rode this rally here. Look, because the risk went down, was going down, 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 and was just holding the S&P 500. So I'm making money here. And I avoided this the entire downturn. Okay, so here is October of 2018. We talked about it right here. This is August 2015. This is Chinese yuan devaluation. The European debt crisis, 2011. Right, Volgamadden, February 2018. And this is more recent. This is the Liberation Day, April 2nd, 2025. Right, we also avoided. Okay, so the number one goal here is to avoid crashes. All right, and then let's take to the next level. So imagine you're traveling on a on a road, on your journey, and then you encounter bad pavement, good pavement, and great pavement, right? So when you encounter bad pavement, you slow down. You don't want to end up, in a mechanics shop because you destroyed the struts of your car, right? Okay, so you're going to waste a lot of time there. So you got to slow down here. And if the pavement's good, you can accelerate. If you have a great quality, you can accelerate even more, right? So this strategy is an analogy for our strategy here. So if the market risk is high, we're going to slow down. We're going to rotate to safe assets. Safe assets will have lower return. That's fine, right? But we're going to slow down here. But when the risk is low, we can accelerate. We should be confident enough to accelerate with higher returns, right? We can go for a riskier assets. That's what I'm saying. So here illustrates the examples. This is strategy number 6. Okay, so we have here low risk, medium risk, and high risk. When it's medium risk, I'm invested in the S&P 500. And if high risk, I'm switching to gold, all right, for protection. This is my safe asset, okay? And I have 2 risk assets here. And SSO is double the S&P 500, okay? It's twice, right? So it's very risky. I wouldn't use this in a situation, the high risk situation, because I'm going to lose money for sure. But because I have a risk indicator, I can do this because I know the risk is low. If the risk is low, I can confidently invest in a riskier asset. It's like you are here on a great pavement, you're gonna just speed up even more. Okay, you're gonna go fast, right? You can't do this here. You can't hold the SSO here. It's too risky. It's gonna destroy you, right? But here, no, it's gonna give you a great push forward. All right. So this is what happened as a result. Look, strategy 6 is much better than strategy 1, right? So 2022, the S&P 500 ended with minus 20%, pretty much. But look at strategy 6, 33% up. Strategy 1 was like flat, right? But strategy 6, 33% up, okay? So this gap is even wider. And look at this, the drawdowns. It's you see, it's returning so much more, strategy 6, but the drawdowns are not greater than the S&P 500. So this is more efficient than strategy 1. Strategy 6 is more efficient than strategy 1 because, it's returning a lot more, but still with um, lower drawdowns, lower risk than um, the S&P 500. Okay, it's worth it. Of course it is. Okay, you bet. All right, look at this. That was the first place in 2022. Okay, in a year that was a bear market year. All right. Okay, perfect. All right, so the solution is very simple. It's easy to use, right? So every time the risk 500, which is this number here, right? First, you select your own risk tolerance cutoff level, right? So in this case here, because this is a percentile rank, right? It's easy to understand how it works, right? So like, if I am a moderate risk investor, I tolerate moderate risks, right? I'm not super aggressive. I'm not super conservative. Someone who's super conservative should select a RPT, a cutoff, lower cutoff, like 70% perhaps, right? But a more aggressive investor might select 80 or 85 or even 90%, right? But I'm a moderate. I'm gonna go 75%. Mine is 75%. Okay. So for me, every time the risk 500 that you read every day by email, I'm gonna send you every day by email, and you'll know it's too hot for you, right? It's too hot, it's too risky. So you're gonna switch to, rotate to safe assets. That's it. And when it comes down, you will rotate back to risk assets again. Okay, that's it. That's simple, right? Okay, it will take less than 1 minute a day. 5 minutes if you need to do some action here. So let's say your RPT, the RPT crossed your RPT level. Sorry, the risk 500 number crossed your RPT or cutoff level, right? So you may do some trades here. Oh yes, I have to trade here. Gonna buy or sell. All right, that's all. And maybe you'll spend 5 minutes doing that, right? But most of the time, it's just a few seconds a day. All right, it's not gonna it's take too much of your time. You don't need to study the market, do a lot of things. It's very easy to use. Okay. All right. So just 1, 2, 3, less than 5 minutes a day. Average is 2 to 3 trades a month. No, okay, it's very easy. So my recommendation here is that you should give a Smigger a try. Start small with very little money. Just test it out. You don't need to put a lot of money here. Just a few $100s, $1,000. That's fine. Okay, you can test it out. If you don't like it, you don't use it. That's fine. That's easy, right? So and you have three options how I can help you, right? If you need my help, well, there are three ways. So one is if you want to study, I'm going to produce courses that you can take. If you have the time, you want to learn, and do it yourself, we can do it that way. If you want it done for you, you can simply subscribe the risk 500 risk indicator that's published every day. That's the easiest way to do it, right? Safely, easily, inexpensively, and successfully. It's ideal for busy people. Okay. Or if you want to learn and implement your investing system quickly yourself, right? You can take our Express Mentorship Program. It consists of 2 learning sessions only, and plus 6 months of coaching with biweekly Q&A to help you build a successful system. All right, so I can help you build your own RISP 500. It's of course not going to be the same, but then you understand exactly what's behind, what's the what variables you use to okay, and what we explained today about the Fed watch tool, that will be also one of the variables that we're going to watch. This is very important. Okay, that's why I took a long time to explain with so much detail. Okay. All right. So again, those three options how it can help you is if you want to study, you can take courses. If you want done for you, you can subscribe the indicator. Or if you prefer to learn and implement your own system and quickly, without sitting to take long courses, that kind of stuff, you can do our Express Mentorship. All right. And you can contact us. The link is going to be on the description of the video, or email us. All right. Perfect. You can also join our club. Why not? Right? You're more than welcome to join our club if you're not a member yet. And so you can read this later. There's a lots of benefits for people joining the club. All right. I'm gonna give you a welcome gift. One of my books here, Achieving Wealth Preservation with High Returns. All right. This has been written for wealth managers, okay, but for individuals the message is the same. Okay. All right. Okay, so here we conclude. Thank you so much for staying with us here, and I hope this was a good learning experience for you, that you were able to um, take away good insights and actionable insight that you can use and help your investment journey. Okay. And I will see you next Wednesday. Mark your calendar. All right. Thank you so much and have a great rest of the week. Thank you. Bye bye now. Bye. Good night.